Welcome to this comprehensive guide on pips, lots, and leverage in Forex trading. These are fundamental concepts every beginner must grasp to trade confidently. In this video, we will break down each term in simple language and show how they connect. By the end, you'll understand how pips measure price movement, how lot sizes determine trade volume, and how leverage can amplify both profits and losses. We'll also walk through practical examples, from calculating pips on USD versus JPY currency pairs to seeing how leverage affects your margin and risk. Throughout, we'll use clear visuals, charts, tables, and trading platform screenshots to reinforce each concept. So, let's dive in and build a solid foundation for your Forex trading journey. Every second counts in trading, and XM delivers speed you can trust. With execution under 1 second, ultra-low spreads, and zero requotes, XM ensures your trades happen exactly when you want them to. Trade Forex, indices, metals, and crypto, all in one powerful platform. Get access to real-time market insights, professional support, and flexible leverage tailored to your trading style. From beginners to professionals, XM helps you turn every move into opportunity. Don't wait. Click the link in the description and trade faster with XM today. A pip, short for percentage in point, is the smallest unit of price change in the Forex market. In most currency pairs, a pip is a movement in the fourth decimal place, equal to 0.0001, which is 1/100th of 1%. For example, if EUR/USD moves from 1.1050 to 1.1051, that 0.001 rise in price is 1 pip. Pips are the standard measure to quote exchange rate changes. You'll often hear traders say things like, I made 20 pips on that trade, meaning the price moved 20.001, 0.20, i.e. 0.2% in price, in their favor. However, there is an important exception for currency pairs involving the Japanese yen, JPY. JPY pairs are typically quoted with only 2 decimal places, so 1 pip is 0.01 for those pairs. In other words, if USD JPY moves from 150.0 to 150.01, that 0.01 change is 1 pip. So for most pairs, 1 pip stars 0.001, but for JPY pairs, 1 pip stars 0.01. Despite this difference in decimal placement, the pip still represents the smallest price movement for that pair. Why do pips matter? Pips allow traders to calculate profits and losses. Each pip movement can be assigned a monetary value based on the trade size, lot size, and the currency pair. For example, a 20 pip gain on a trade will translate to a certain profit in your account currency. We'll see how to compute that shortly. First, let's solidify the concept with a couple more examples. USD example. If USD rises from 1.1000 to 1.1010, it has moved 10 pips higher. Conversely, a drop from 1.1000 to 1.0985 would be a 15 pip decrease. On a price chart, these moves might look small, but in terms of pips, they quantify the change precisely. USD JPY example. If USD JPY goes from 150 SARs to 150.10, that is a 10 pip increase. A move from 150 SAR down to 149.50 would be a 50 pip drop. Even though JPY pairs are quoted to 2 decimals, we count pips in a similar way, just using 0.01 increments. Notice that a pip is a fixed size, 0.001 or 0.01, in the quote currency, but its value in your account currency can vary. It depends on factors like the lot size of your trade and the specific currency pair's exchange rate. For instance, if you trade EUR/USD with a standard lot, 100,000 units of EUR, each pip is worth about $10 in profit or loss. That means a 10 pip move would result in a $100 change in your PL. On the other hand, if you trade a smaller lot, the value per pip is smaller. We'll detail this in the next section on lot sizes. Also, if you trade a pair where USD is not the quote currency, the pip's dollar value will differ. For example, at an exchange rate of about USD JPY 119.80, 1 pip, Y0.01 is worth roughly 8.34 for a standard lot, not a full $10 due to the USD JPY rate. We generally don't need to manually calculate these values because modern trading platforms do it for us, but it's good to understand that pip value, shark pip size, shark exchange rate x lot size. You might have noticed some brokers quote prices to an extra decimal place. For instance, EUR USD Chabas 1.10527 instead of 1.105.2. That fifth decimal digit is known as a pipette, or a fractional pip, and it equals 1/10 of a pip. In our EUR USD example, a move from 1.10520 to 1.10530 is a 1 pip move, even though the last digit changed by 10. The fifth decimal just provides more precision, 1 pip, our 10 pipettes. Similarly, for JPY pairs, quotes may go to 3 decimals, e.g. 150.115, where the third decimal is a pipette worth 0.001. Important. When calculating pips manually, you can ignore that extra digit or remember that 10 pipettes, short for 1 pip. Trading platforms often display the pipette in a smaller font or superscript to remind you it's a fractional pip. For simplicity, this tutorial focuses on whole pips, but be aware of pipettes when you see 5 or 3 decimal quotes on your platform. Now that we know what a pip is, let's talk about lot sizes. In Forex, trades are executed in standardized units called lots. You don't trade just €1 or $1. Instead, currencies are traded in batches of currency units. A lot is basically the size of your trade or position, the number of base currency units you are buying or selling. There are several common lot sizes in Forex. Standard lot, 100,000 units of the base currency, often just called one lot. This is the default full-size lot. For example, one standard lot of EUR USD is $100,000. Mini lot, 10,000 units of the base currency. This is 0.1 of a standard lot. Many beginner accounts use mini lots, sometimes written as 0.1 lots in trading platforms. Micro lot, 1,000 units of the base currency, or 0.01 of a standard lot. New traders often start with micro lots. Nano lot, 100 units of the base currency, or 0.01 of a standard lot. Not all brokers offer nano lots, but they exist for very small trade sizes. In summary, standard shear 100,000, mini shear 10,000, micro shear 1,000, nano shear 100 units. These lot categories let traders scale their position sizes according to account size and risk tolerance. Lot size directly affects the pip value of your trades. Recall our earlier statement. With a standard lot, a 0.001 movement is about $10. Let's confirm the pip values for each lot size, assuming a USD quoted pair for simplicity. Standard lot, 100,000 units, just $10 per pip movement. Mini lot, 10,000 units, 1 per pip. Micro lot, 1,000 units, 10 cents per pip. Nano lot, 100 units, always 0.01, 1 cent per pip. These are typical values for currency pairs where the US dollar is the quote currency, e.g. EUR, USD, GBP, USD. For other pairs, the pips USD value might be slightly different, but the relative scaling between lot sizes remains. A standard lot pip value is 10x a minis, 100x a micros, and 1000x a nanos. Why use different lot sizes? It comes down to risk and account size. Larger lots mean each pip is worth more money, so profits and losses are magnified. Smaller lots mean each pip is worth less, which can make losses more manageable for beginners. For example, if a market moves 50 pips against you, with one standard lot, that's roughly a $500 loss, 50 pips x 10. With one mini lot, it'd be about $50, 50 pips x 1. With one micro lot, only $5, 50 pips x 0.10. A new trader with a small account would likely survive a $5 loss more easily than a $500 loss. This is why trading micro or mini lots is advised when starting out. It allows you to practice and learn without risking too much on each trade. As your confidence and account grow, you might increase lot size gradually. It's also worth noting that some trading platforms let you input position size in actual units instead of lots. For instance, you could trade 20,000 units, which is 2 mini lots, even if your broker quotes it as 0.2 lots. Just remember the conversion. 1.00 lot, mangri 100,000 units. Many brokers today offer position size calculators or display the pip value as you set the lot size, helping you see the dollar value per pip before you enter the trade. By understanding this, you can calculate your potential profit or loss for a given trade. For instance, if you anticipate a 20 pip gain on a trade and you trade 0.5 standard lots, which is 50,000 units, so $5 per pip, you could expect about $100 profit, 20 pips x $5 pip. If you only traded 0.05 lots, 5,000 units, 50 cents per pip, the same 20 pips would net you $10. The concept of position sizing is critical in risk management. You choose a lot size that suits your account and risk appetite for each trade. Moving on to leverage, a concept that makes Forex trading accessible but can be a double-edged sword. Leverage allows traders to control a large position with a relatively small amount of capital. In essence, the broker lends you funds to increase your trading power, requiring only a deposit margin from you as collateral. Leverage is expressed as a ratio, like 50.1, 100.1, 500.1, etc. For example, a 50.1 leverage, often written as 150, means you can control $50 in the market for every $1 in your account. Put another way, you only need 2% margin, 150, of the total position value. A 100.1 leverage means you can control $100 for every $1 you have, requiring 1% margin, and 500.1 means $500 for every $1, a mere 0.2% margin required. How does leverage work in practice? Think of your trading account and broker like this. Your broker is temporarily fronting you the full value of the trade, but they hold a small good faith deposit from you, the margin, to cover potential losses. Let's illustrate with an example. Suppose you have $1,000 in your account, and your broker offers 100.1 leverage. This means you could theoretically control up to $100,000 in currency, because 100x $1,000, $100,000. If you wanted to open a trade of one standard lot on EUR/USD, which is $100,000 worth of currency, you would need to put up about 1% of that as margin, $1,000, to open the trade. Effectively, your $1,000 is held as the margin deposit, and the broker loans you the other $99,000 to make the full 100K position. If the trade is closed, whether at a profit or loss, that margin is released back to your account with adjustments for PL. The margin is not a fee, it's just collateral. As long as the trade is open, you must maintain that margin amount, an additional buffer for any losses, in your account equity. Let's see how leverage amplifies profits and losses with a concrete scenario. Assume the same $1,000 account at 100.1 leverage, where you open a $100,000 position, one standard lot, on a currency pair. Positive outcome. If the trade moves in your favor by 50 pips, and for simplicity, assume it's a USD quoted pair so each pip is $10 per lot, you gain $500, $50 pips x 10 a pip. A $500 profit on a $1,000 account is a massive plus 150% return on that single trade. This showcases the power of leverage. Such a large position can yield big gains from relatively small market moves. Negative outcome, but if the trade moves against you by 50 pips, you'd lose $500. 50 pips x $10 pip. That's a 50% loss of your account. Without leverage, if you could only trade $1,000, no borrowing, a 50 pip move with a micro lot, where each pip is 0.10, would have been only a $5 gain or loss. Leverage magnifies your results in both directions. This cannot be stressed enough. Most brokers will let you choose your leverage up to a maximum, often 100.1, 200.1, or more, depending on regulations. It's important to note that you don't have to use all your leverage. For instance, having the ability to use 100.1 doesn't mean you must open positions worth 100 times your account on every trade. You could still trade smaller positions, like zero point 0.1 lots on a $1,000 account. $10,000 position, using only $100 margin, which is 10.1 usage in effect. Leverage gives you flexibility to trade bigger, but it's wise to use it judiciously. Whenever you open a leveraged trade, a portion of your account is held as margin. Margin is typically quoted as a percentage of the position. For example, 1% margin requirement, which corresponds to 100.1 leverage, means for each $100,000 traded, $1,000 is required as margin. If you opened a 0.5 lot position, $50,000 position, with 1% margin, the required margin would be $500. Your trading platform will usually show used margin, the total margin tied up in open trades, and free margin, the equity left that can cover new trades or losses. It is critical to maintain enough free margin because if your trades start losing money, those losses subtract from your account equity. If your equity falls too low relative to the used margin, you can hit what's called a margin call. A margin call is essentially a warning, or automated action, that you don't have enough funds to sustain your current open positions. Specifically, if your equity, account balance plus PL, drops to equal the used margin, your margin level is 100%. And at that point, brokers typically alert you or automatically start closing positions to limit further losses. In practice, many brokers will automatically close your trades once your equity hits the required margin level. Some even before 100%, say at 50% margin level. This forced closure is to prevent your account from going negative. Scenario: margin call in action. To illustrate, imagine you have $10,000 and open a large position that requires $8,000 margin. For example, 80 mini lots on a 1% margin account. This is an extreme position size for a 10K account. This leaves you with $2,000 in free margin to absorb any losses. Now, if the market goes against you, with 80 mini lots, each pip move is $80 in this case. A mere 25 pip drop would cause a $2,000 loss. 25 pips x 80 pip carries 2,000, wiping out your free margin. Your equity would then equal the $8,000 used margin, hitting the 100% margin level. At that point, a margin call is triggered, and the broker's system will start closing your position. Essentially, you'd be forced out of the trade with a heavy loss, and you'd be left with only the remaining $8,000, minus any additional spread fees costs. A 25 pip routine market move could knock out 20% of the account because the position was extremely leveraged. This example underscores how dangerous over-leveraging can be. On the other hand, if you had used a much smaller portion of your leverage, say 2 mini lots requiring $200 margin, leaving $800 free, a 25 pip drop would be only $50 loss at 2 pip, easily sustained by the account, and you'd not face a margin call. The key is maintaining a healthy margin level by not overextending your position sizes. A general rule of thumb: never use all the leverage available to you. Give your trades breathing room to fluctuate. Important: leverage is often cited as a top reason why new traders blow up their accounts. High leverage gives you the ability to take large positions, but that doesn't mean you should max it out. Always consider the worst-case scenario. If the market moves against you by X pips, will you still be in the game? Professional traders often use only a fraction of the leverage available to them, aiming to risk only a small percentage of their capital per trade, like 1 to 2%. This way, no single trade or string of trades will wipe them out. Let's bring the concepts together with a comprehensive example. You have a $5,000 trading account. You decide to go long one mini lot of GBP USD, 10,000 pounds, at an exchange rate of 1,003,000, using 50.1 leverage. The notional value of this trade is $13,000, because 10,000 GBP x $13,000 earned $13,000. At 50.1 leverage, the required margin is 2% of $13,000, which is $260. So $260 of your account is set aside as margin for this trade, leaving you with $4,740 free margin. Each pip for a mini lot of GBP USD is approximately $1, technically a bit more since USD is the quote currency here, about 130 per pip in this case, because pip value she rouse 10,000 x 0,000 on 1 x USD GBP rate will approximate $1 for simplicity. Now, if GBP USD rises to 1.3100, that's a 100 pip increase. Your profit would be roughly 100 pips x 1 pip for a mini lot. Your account equity becomes 5,100. You used leverage to control 13K worth of currency with only 5K capital, and it worked out well in this instance. If instead, GBP USD fell to 1.2900, 100 pips down, you'd lose $100. Your equity would drop to $4,900. You'd still have plenty of margin remaining, no margin call risk yet, since your equity $4,900 is far above the 260 margin used. You could choose to close the trade to cut loss or keep it open if you believe it'll rebound, but be mindful that further losses will continue to erode your free margin. Had you taken a much larger position, say 5 mini lots in BOS 0.5 standard, $65,000 position, on the same $5,000 account, the margin required would be $1,300 and each pip about $5. A 100 pip move against you then means $500 loss, 10% of your account, and equity down to $4,500. A 200 pip move, 2% change in GBP USD, which can happen in a day or two, would be $1,000 loss, equity $4,000. You can see how bigger lots, thanks to high leverage, increase risk to your capital. The takeaway: leverage and lot size should be used in moderation and aligned with your risk management strategy. Always calculate the potential pip loss in dollar terms, and ensure it's an amount you are willing to risk. This is where a sound understanding of pips, lots, and leverage comes full circle into practical trading decisions. Before we wrap up, let's highlight a few common mistakes new traders make regarding pips, lots, and leverage, and how to avoid them. Over-leveraging trades. This is the #1 account killer. Using the maximum leverage available to take very large positions can lead to margin calls or total account wipeout. Many excited beginners open huge trades relative to their account size, only to see a normal market swing blow up their account. Avoidance. Use moderate leverage. Don't risk too large a percentage of your capital on one trade. It's better to trade smaller and survive adverse moves. Miscalculating pip values. Some beginners forget or aren't aware that pip value changes with lot size. If you're used to demo trading 0.1 lots, mini lots, and then accidentally trade one lot, the pip value is 10x larger. Any losses will be 10x bigger too. Also, different pairs can have different pip values, as we saw with JPY pairs or cross currencies, which can throw off profit-loss calculations. Avoidance. Double-check your position size and know the pip value before entering a trade. Use the tools available. Many platforms display pip value, or you can use a pip value calculator. Practice calculating a few by hand to get a feel. Choosing incorrect lot sizes. Trading too large a lot for your account is related to over-leveraging, but it can happen even without maxing out your leverage. For instance, a trader might think 10 pips isn't much, I can risk 10 pips. But if they trade 5 standard lots, that 10 pip move is $5,000. Avoidance. Calculate the dollar risk. A good rule of thumb is to risk only a small percentage of your account on any trade, commonly 1–2%. Adjust your lot size so that stop loss in pips x pip value, your acceptable risk. This way you won't accidentally bet the farm on one trade. By steering clear of these mistakes, you will use pips, lots, and leverage as the helpful tools they are, rather than letting them work against you. Understanding pips, lots, and leverage is fundamental to Forex trading success. These concepts are the building blocks that allow you to calculate profits, losses, and manage your trading risk effectively. As we've explained, a pip is the tiny price movement that can add up to big money depending on your lot size, and leverage is the force multiplier that can either boost your returns or amplify your losses. With this knowledge, You should feel more confident reading Forex price quotes, sizing your trades appropriately, and appreciating the power and danger of leverage. Remember that successful trading isn't about avoiding risk altogether, it's about understanding and managing risk. Use leverage wisely. It's a fantastic tool when used with caution and proper risk management, like stop-loss orders and sensible position sizes, but it demands respect. As a next step, try applying these concepts on a demo trading platform, such as MT4, MT5, or a TradingView paper trading account. Practice calculating pip gains, losses on your trades, experiment with different lot sizes, and see how much margin is used at various leverage levels. The visuals and examples we've covered should guide you. Picture the charts, the pip movements labeled, the lot size tables, and the margin call scenarios as you plan your trades. By mastering pips, lots, and leverage, you build a strong foundation for all future Forex learning. These basics will be crucial when you progress to topics like stop-loss placement, position sizing strategies, and advanced risk management. Keep this lesson as a reference, and happy trading. May your pips be plentiful and your leverage always under control.